Hello, welcome to the video 3 of day 2. Here we will discuss about the first secret which is necessary to earn consistent monthly income from share market, and that is risk management. Risk management is the most important topic in trading. In share market there is risk. We have to accept it, and if there is risk, we should know how to manage it. People don't know how to manage the risk. That's why they lose a lot of money, a lot of capital. So, where does the risk come from? Risk comes from no knowledge or improper knowledge. People come into trading with a lot of capital but without any knowledge, and that's why they lose their money. But if we gain knowledge, proper knowledge, then we can protect our capital. Risk comes from the fear of losing capital. There is always a fear that we will lose capital. So, therefore, managing our risk is very important in order to protect our capital. Next, we come to intention. What is our intention? We should be very clear about our intention. And our intention is to protect our capital. This is our intention. We should be very clear about it. Next comes low risk, low return, and high risk, high return. Means if we take low risk, we will get low return. And if we take high risk, we will get high return. But everybody wants high returns. Even I want high return, you want high return, but for that we have to take high risk. And here comes the problem. Taking high risk means we are putting a lot of money on the table which we can lose. So therefore this strategy is not very useful. And the second one is low risk and low return. Here we take low risk, we get low return. But our first focus should be to protect our capital, and for that we need to take low risk. And if we take low risk, we will get low return. So this is the strategy which we should focus on: low risk, low return, and we should be satisfied with low return. This is very much important. So how low can be the low return? It can be 1% per month. It can be 2% per month. This much low can be our low return, and we should be happy with this. We should be satisfied with this. See, this comes out to 12% per year. This comes out to 24% per year. Now see this. 12% per year is not a bad return. 24% per year is not a bad return. It is very much acceptable, and we should be satisfied with this. If we are satisfied with this, we can get more return, or we will become ready to get more return. But if we don't accept this, then we cannot manage our risk properly. So we should use this strategy: low risk, low return, and we should be happy or satisfied with low return. So moving ahead, we come to how to manage risk. Now, we have to manage our risk. There are two ways to manage the risk. I will write it down. First is put stop loss. When we put stop loss, then we predefine our risk, that this much amount I can I am ready to lose if trade goes against me. So this is one way to manage our risk. Suppose I bought a share at rupees 100. Suppose I bought one share of a company at rupees 100 and I have put stop loss of rupees 5 SL. Stop loss of rupees 5 means I am ready to lose 5 rupees on one share. So I have predefined my risk. I have predefined my loss. So therefore, one way to manage our risk is to put stop loss. So there is one more way, that is hedging. By hedging also we can manage our risk. And this is the thing we will be focusing on. In stop loss, if we carry forward our trade, means if we carry forward my trade to suppose next day, or if I take a positional trade for the same 5 days, then I cannot put stop loss for 5 days. My stop loss will be removed when the market closes, just before the market closes. So in that case, stop loss, then in that case, how can we manage our risk? Here hedging comes into picture. Okay, and one more problem with stop loss is that sometimes it gets bypassed. Suppose I put my stop loss at 95. Suppose I bought my share at 100 and my stop loss is at 95. But what happens? Share goes, sudden fall comes and share goes to rupees 90 directly. Then what will happen? This stop loss gets bypassed and my stop loss is not hit. And I am still in the position with 10 rupees loss. So this can happen. So therefore, stop loss is not totally reliable. Sometimes it can fail. It may get bypassed or it may get rejected, or that stock may get freezed. Such things happen. Sometimes system breakdown happens. So that way we can get stuck. Okay. So to overcome these problems, this strategy comes into picture. In this one, we place one trade and we place an opposite trade to counter that trade. Means we play in both directions. Suppose trade goes against us, means against our direction, then the opposite trade which we have taken, it reduces our risk, it reduces our loss. Okay, it's just like paying premium. We are paying extra premium to reduce our risk, to reduce our loss. Like suppose I will take an example. Let's suppose I have bought one lot of call option. Suppose I have bought one lot of call option. So what will I do? Suppose I have sold. Suppose I have sold one lot of call option, then I will buy one lot of call option of the above strike, so that my loss is reduced if market goes against me. So these are the ways. We will see this hedging strategies in detail in our bonus course, which is called as Hedging Strategies Blueprint. Okay, so in hedging, just for time being, remember that in hedging we play in both direction. We play in both direction and we pay extra premium, extra money just to protect us if we go wrong, and that is very necessary. We can go wrong. No one knows perfectly what will happen. We just predict what can happen and act accordingly. But if market goes against us, what is our plan? So for that we do the hedging. We are anticipating that market, I can go wrong, you can go wrong. So if I go wrong, then how much loss will I take? Or how will my capital be protected? For that we use hedging. So therefore, there are two ways to manage our risk. One is by putting stop loss and another is by hedging. And one more point is that hedging does not completely eliminate our risk. It's not like that. It just reduces our risk. Means if market goes against our direction, then we will make loss. But that loss will be less. It will not affect us much. That loss will be small. So that's the point of hedging. Our loss will not be completely eliminated, but it will be reduced to a small loss. So that's the point here. So let's just recap what we have learned in this video. We have learned about risk management, which is the first secret in making consistent monthly income. Risk comes from not knowing what we are doing. It comes from improper knowledge. It comes from the fear of losing capital. And our intention is to protect our capital. We will go for low risk, low return strategy. We are satisfied with low return. And there are two ways to reduce risk. One is by putting stop loss and another is by hedging. So I would like you to share your learnings from this video in the comments below so that this learning gets fixed into your mind. So write your learnings in the comment below and see you in the next video.